When a government has the power to create money, those in power simply create new money whenever they want more money to spend. History clearly shows that governments have been the most consistently guilty party in the inflation of the money supply.
You'll often see people arguing that if we just had a gold standard, a quote-unquote gold standard, then everything would be better. We'd have a freer society, and we wouldn't have, in particular, monetary inflation or price inflation. Today I want to focus just upon the idea of a gold standard and whether or not, in fact, it is the panacea that a lot of people think it is. Now, there are different ways of describing the gold standard. Different people think it means different things. On the one hand, a gold standard could mean literally that the government simply takes pieces of gold and mints them into coins. So for example, this is a 1 ounce coin, or this is a ½ ounce coin, etc. Another thing called the gold standard is where the government prints notes, but the notes say on them something to the effect of, this note can be exchanged for a certain amount of gold. In that case, the note is serving as a claim ticket, effectively, for the gold, and the gold is usually then stored in some kind of government facility. Why is it that people think that gold is the way to limit inflation? Well, it's because gold is a naturally occurring substance. It has to be mined, taken out of the earth. There are limited quantities of gold in and on the globe, and therefore there's a limited amount of gold that could be used as money. And therefore there's a natural limit on the inflation of the money supply, if gold is the money supply. If, however, the government starts printing pieces of paper to represent a certain quantity of gold, that natural limit is automatically lost, because the amount of gold that each piece of paper represents will be set out in law. And so the law could say on one date, this piece of paper represents 1 ounce of gold, and on the following day the law could be changed and it could say this piece of paper now represents half of that quantity of gold, and so on. And it could be changed every day, in fact, until finally the same piece of paper could not be exchanged for any amount of gold, all because some politicians changed the law. Now, of course, they can't erase the value of gold itself, and so it's only when you represent gold with pieces of paper, or you make claim checks for gold on pieces of paper, that's when the natural limits on the quantity of gold are no longer of any use in limiting the supply of money. Now, there are various histories, and I'm not about to go into all of them. In each country there's a history of how, gold went out of circulation, paper came into circulation, usually because of governments manipulating the ratio of the value of the paper to the amount of gold that could be obtained in exchange for the paper. And in almost every story it becomes the case that the government says, okay, you can no longer exchange paper for gold, we no longer have to give you any gold for the paper. And eventually the idea is that the government just starts creating as much paper as it wants to, starts inflating the supply of dollars so that each dollar becomes worth less and less and less over time.
The use of printed paper money as a medium of exchange goes back in history many centuries and appears to have begun in China. Marco Polo returned from China with a tale of how the Emperor Kublai Khan had seized all the gold in his domain, and then issued pieces of paper with a value written on them, which the people had to accept at face value. This scheme soon found favor in other parts of the world. Governments discovered they could obtain money by simply printing paper, and they did so. The results of fiat money have always been disastrous for the people who actually created the goods and services that existed. The experience of the people of Germany following World War I is a graphic example. In 1922, the people of Germany were suffering through severe shortages of material goods and rapidly rising prices, while their political leaders were increasing government spending and simply issuing unbacked paper money to pay the bills. In Germany, million, billion, and finally trillion mark notes became commonplace but worthless. The postage to send a local letter was 100 billion marks, and a sack of paper money brought only a single loaf of bread. Those on fixed incomes and the thrifty, responsible people who had savings, insurance policies, and other investments lost everything they had worked a lifetime for. They were the victims of their own government's manipulation of the money supply.
That's the general framework of the story about gold and paper. But let's just say that for all intents and purposes we had a government that was willing to get entirely rid of any paper representation of gold. So from now on, your government was going to do nothing more than take pieces of gold and print them into coins marked 1 ounce, half ounce, quarter ounce, or what have you. Would that mean that there would be no more inflation? Well, not in and of itself, no. Why not? Because there are two kinds of money, currency and credit. The only way to prevent an increase in the money supply is to make sure that you both prevent an increase in the supply of currency and prevent an increase in the supply of credit. If you've been watching prior episodes of Understanding Money and Banking, you'll know that when a bank lends out money, it does this. It first takes money in as a deposit from somebody, and in exchange for that money the banks issue to the person who deposited the money an IOU. Now the bank holds some asset that the depositor deposited with the bank. Now it's not that a single bank does it, but the banking system as a whole does in fact lend out the same dollar, the same, let's use the example we're using here, the same coin numerous times, tens of times. In fact, in Canada there is no law specifying any limit on how many times the same coin or same dollar can be loaned out by the banking system. There's an unlimited amount of credit creation permitted by Canadian law. In the United States, there is what they call a reserve requirement, which says that the same dollar can only be loaned out so many times.
You like potato?
And you like potato?
You like tomato?
And you like tomato?
Potato?
Potato?
Tomato?
Tomato?
Let's go
For every dollar of credit the bank has issued, there's only a small fraction of actual money to back those loans. The banks are lending out the same dollar tens of times. And they do so knowing that only a fraction of the time is anyone actually going to come in and ask for either that Federal Reserve note or, in this example, the gold coin. So they know that 19 out of 20 people, for example, on any given day, are not going to come in and say, hey, you owe me a gold coin, I want it now. Now obviously, if private banks are allowed to lend out the same dollar or the same ounce of gold multiples of times, numerous times, then preventing your national government from increasing the supply of money, whether it's the supply of dollars or the number of ounces of gold, is only one part of the problem. Unless the banks are prevented from lending out the same money, the same dollar, over and over and over again to numerous different people, then there will be money creation by the banks. The money supply will be increased by the private banks.
Hurry, go road checks incredibly fast, but a personality didn't have the cash. I laughed out loud through my total dismay. She ain't pretty, she just looks that way.
Because there are two kinds of money, currency and credit, the only way to prevent an increase in the money supply is to make sure that you both prevent an increase in the supply of currency and prevent an increase in the supply of credit. You do the first by either, making sure that government has no function other than, say, minting gold coins but never creating any dollars, or by ensuring that the government at no time has authority to increase the total number of dollars that are issued by its central bank. You do the second by imposing a 100% reserve requirement on all lending institutions. In other words, by preventing them from lending out dollars that they don't have, gold that they don't have. Promises to pay are not enough. They must have what it is they're promising to pay before they promise to pay it. Otherwise, they are inflating the money supply. And at that point, they're taking value out of your savings, out of your earnings, transferring it to themselves, lending it out to a third party in exchange for interest. They're making money on the money you should have been making money on. So the best combination would be zero increase by the government and zero increase by the banks. This doesn't mean the banks would stop lending out money. It simply means that the banks would only lend out whatever they bring in first. In other words, they could only lend out actual deposits. They couldn't lend out the same deposit to numerous people at the same time. They could only lend out $1 to one person, not to 20. Now that's called a 100% reserve requirement. In other words, for every dollar of credit you issue as a bank, you have to have $1 of money sitting in your account. Whether that money is Federal Reserve dollars or whether that money is an ounce of gold or some multiple of ounces of gold. In other words, you can't lend out what you don't already have. You can't create money in order to lend it out. You have to lend out only that which you already have in your possession or that you already own. Now you might ask, well, how would this be possible? If a person comes in and deposits a $1 coin or a 1 ounce coin, how is the bank going to both honor its debt to that depositor and lend the money out to some other person? Well, it wouldn't do both simultaneously. A person who deposited, say, a 1 ounce coin of gold would do it on the understanding that the bank was going to lend that coin out to someone else for some period of time. And during that period of time, the depositor would have no right to the return of his 1 ounce coin. This is called a time deposit, and they exist right now. If, on the other hand, you just wanted to store your money in the bank, that would be money that the bank would not be permitted to lend out to anybody. The bank in that case would be literally acting as a storage device, and you would probably actually have to pay the bank a fee for the storage of your money in exchange for the service they're providing. So there would be no change to the fact that dollars would be loaned out by banks. There would be no change to the fact that the banks would charge a fee, in other words interest, for the money that they create and lend out to people. There would be no change to the fact that in fact banks were creating credit. It's just that they'd be creating only $1 of credit for every dollar of Federal Reserve note or every $1 worth of gold that they already hold as a deposit. And they would not simultaneously owe that money to a depositor. Now you might say, well then wouldn't that create a shortage in the amount of credit that's available? Not at all. Why not? Well, because banks, instead of just creating dollars on the fly, would start encouraging people to deposit their money as savings and would pay people a half-decent share of the money that they're charging for the loan. In other words, if a bank is charging 8% to borrow money, it might share 1 or 2 or 3% with the depositor of the money. So savings would actually be a way to make money. You deposit money with the bank lends it out to someone who needs it, and gives you a fraction of the interest that the bank owns for the service.
What moral right do we have to create purchasing power out of thin air? Whether it's done by the creation of credit or Federal Reserve notes, or whether it's the creation of SDRs in an international scope, by what right do they do this? Is it any more moral to dilute the value of your purchasing power of the money you hold in your wallet than it is for the farmer to dilute the milk supply with water? It's a moral issue more than an economic issue.
If you don't have $20 in your pocket, you don't have $20 to lend to me. Why should you be lending out an IOU and collecting interest on the IOU when you may never, in fact, have the money to back that IOU? Now, of course, there are many banks that act responsibly and are able to honor their debts. However, the fact remains today that if every depositor went to the bank today and demanded that every dollar of their savings be honored in the form of Federal Reserve notes or central bank notes, depending on which country you're coming from, the private banks would be unable to honor those demands. They would be unable. That would constitute what's called a run on the bank, and all of the banks would be immediately insolvent, possibly on the verge of bankruptcy then. The fact is that they're gambling on a day-to-day basis, that people will not come in and make a claim for actual physical cash, because if everyone does it at the same time, the whole deck of cards comes down. So the only thing keeping banks afloat right now is the fact that people aren't using cash. They aren't demanding cash. They're keeping their savings in the form of credit, and they're using credit cards and checks to switch who owns that credit, but they're not ever really pulling it out of the bank in sufficient quantities to pose a threat to the deck of cards that the banks have set up. Returning to a gold standard by itself would not have the effect of preventing inflation, because the banks would still be free to increase the money supply in the form of bank credit. And in fact, the vast majority of dollars that are out there are privately owned bank credit upon which banks are being paid interest, because every dollar of that credit is money that was loaned to someone by the bank and upon which they're paying interest. If you want a money supply that can't be inflated, if you don't want inflation, it's not enough simply to prevent the government from increasing the number of dollars, from increasing the money supply. You must also impose a 100% reserve requirement on private banks so that they can't increase the dollar supply in the form of credit.